Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Is the uptrend here to stay? That is the question that we are going to try to get answered here at this edition of the Roundtable with our research director, Shiraz Mian, our senior stock strategist, Kevin Cook, and our market technician, Kevin Matris. So we've had a lot of positives this October.
That's right.
Bullish month for the stock market. Recently, some fairly good economic news.
Right.
Decent economic reports came out. European debt plan. Let's start with that. European debt plan, does that mean that it's off the table, or is that still a concern?
Well, the broader issue that Europe is dealing with, sovereign debt, growth, recession fears, those are not gone. But the bigger worry that Europe could drag down the entire global financial system through a Lehman type blow up, that I believe has been taken off the table. So by the Eurozone leaders, particularly Germany, coming around, standing behind the common currency through this three-pronged program, providing for a Greek orderly default. They call defaults haircuts these days.
Yes.
And bank recapitalizations and ring fencing Italy and Spain from what's going on in Greece. It has a fair chance of stopping the process. A lot of details still need to come out, but I think it's a good plan by and large.
All right, Kevin Cook. We've had some decent economic news come out over the past week, especially, not the least of which, word that the GDP grew at a 2.5% rate in the third quarter. So that seems to suggest that the U.S. economy has some life in it yet. The question here is, can this reacceleration continue through the end of the year? What do you think?
I don't know if we're going to see 2.5% again in the fourth quarter. But you know, the point is that the recession waiting game is over. And we didn't need last week's number to prove that. The market spoke, okay? Remember, over the summer, in August, I was saying that 1,100 on the S&P was a fundamental value area where long-term investors could take a stab and equity fund managers were licking their chops. But they had to wait. You know, we were playing the recession waiting game. We needed more data. We needed to see how earnings were going to come in. We needed to see if anybody was going to rescue Europe or if it was going to rescue itself, right? And we started to get confirmation of that in early October, and the market got so cheap that fund managers just scooped it up and said, you know what? Europe is going to fix itself. We are less likely to go into recession, and you know, so the market really spoke. And now we've got confirmation of that. The earnings report cards came in and told us recession, that's a silly idea. It's not going to happen. And here we are. You know, the S&P is going to touch 1350 this quarter, is my prediction. May take a dip back down to 1250 on some Euro mess fears. Okay. But I think 1350 is a conservative estimate for year end.
Yeah, you wrote that too, not a stretch.
Right.
Kevin Matris, are you as bullish as the market seems to be?
No. I should be. I'm normally the most bullish guy on this panel. And I do agree with Kevin. I see technically that the market could get up to 1350, and that actually is a long trending resistance line that goes several years back. So I do think that there's a real possibility there. But I'm not, you know, falling all over myself, blowing up balloons and wearing funny hats, because as he had just said, you know, I don't know if we're going to get another 2.5% print in Q4. It's very unlikely. And the thing that has me a bit concerned is a statistic that I had seen over the weekend. And the statistic said, this is going all the way back to like 1948, that every time you see a year-over-year growth rate in GDP of less than 2%, it typically results in a recession. So even though we got 2.5% last quarter, right now, annualized, we're still at 1.6%, so we're under that magic 2% mark. So it's going to be very important to see what happens in Q4 to see if we can get above that level. Now, Gross always talks about new normal, so if the new normal is real, maybe those old statistics don't matter. But if they do matter, this is an important number to pay attention to.
And Shiraz, we cannot forget about the fact that we've got the jobs report coming out this Friday that the market's going to be focused on.
That's right. We have, in fact, this this is a very busy week on the domestic economic front. You have the October jobs. We have the manufacturing ISM tomorrow. Today we had the Chicago PMI.
Yep.
The Fed is meeting. We have Bernanke press conference on Wednesday. So a whole bunch of factors. And if you look at any of these news reports, particularly following the type of gains that we had in October, it could give the market some excuse, some reason to pause a bit. So the overall momentum should remain positive, but you can't completely rule out any of these economic reports, particularly Friday's jobs number, spooky and fearing the market a little bit.
He had to get that Halloween
Halloween,
connection in there, didn't he?
Well played.
Speaking of the Fed meeting this week, it's a two-day meeting starting on Tuesday, going through Wednesday. Anybody have any thoughts on what may come out of it?
I don't think we're going to get anything decisive out of it. Right. What's interesting, though, is that we've got this dissent, which is creating a good dialogue, right? We've got doves and hawks battling it out, and that's the conversation that's going on in the economy anyway. So we're not going to get any QE3. But it is a good conversation to have. I've been a Bernanke fan. He's good at transparency. He's good at taking big action and then waiting to see what happens. So he's not going to nothing will happen this week.
Yeah. Okay. Kevin Matris, give us your top stock pick.
Mine is Manhattan Associates, ticker MANH, and they're a leading provider of technology-based solutions to improve supply chain effectiveness, this kind of thing. What I like about them is they are a Zacks rank of a #1. They just reported a 37% positive EPS surprise, and you can see that their earnings estimates are going up across the board, and they have been on the move ever since. Chart-wise, what I like about them is they just broke out of a bullish flagging pattern, and since that happened, I see the immediate price target as being $46.50. That's a 10% gain from here, but I think there's a lot more to go, and I think ultimately they could hit 55. That is a 30% gain.
Okay. Kevin?
Abbott Labs. All right, I've loved this stock for the past year. Anytime it dips into the 40s, now we've got a big event here. They're splitting the business into two different companies, actually.
Yeah.
Medical products and pharma. Now, pharma is successful. They've got Humira, this drug, but Wall Street doesn't see a lot of growth there. So, but unlocking value by taking medical products, which is, it still has pharma in it because it's got generics. It's medical devices, it's diagnostic equipment for hospitals, and they even have a nutritional segment. This stock now, on this news last week, has launched above 53, which is multi-year highs going back to 2007. And that's just an important breakout, too, and it's held up here, so Wall Street likes it. 3.5% dividend yield, trading 11 times forward earnings, which I expect to go down. And here's the key. Where's the growth come from with medical products and devices and diagnostics? It's emerging markets. Company estimates are going to see 40% of their sales from high-growth emerging markets.
All right, Shiraz.
DuPont. I don't need to describe what DuPont does, but I will say that about 60% of its revenue comes from beyond the U.S., and about a third of its revenue is agriculture and nutritionals related product. Very good growth prospects internationally. The company has excellent balance sheet, very strong cash flows. The earnings outlook looks very solid, as we can see in estimate revisions. On top of that, they pay a very nice and juicy dividend, currently yielding 2.5–3%, a bit higher than that, in fact. Okay. So really good stock.
All right, thank you all. And don't forget, you can get a lot of other interesting commentary and stock stories on our homepage and website, Zacks.com. You can link to all of that off the homepage if you're not there watching this video already. With everyone here, I'm Terry Ruffalo.